Hey everyone, welcome back to Conviction Bets. Hope you're doing well. It's been a wild few weeks out there. Markets have been all over the place. Tariff headlines one day, Fed speculation the next, and somewhere in the middle of all that noise, earnings season snuck up on us again. If you've been glued to the tape lately, you're not alone. This week, though, one company managed to cut through all of it. Amazon just reported the highest operating margin in its history. Beat earnings per share by 70%, beat revenue by $4 billion, and the stock fell. I don't know what you have to do to make Wall Street happy, but apparently doubling the EPS estimate isn't quite it. But here's what actually matters this week. $181.5 billion in quarterly revenue, $37.6 billion from AWS alone, growing 28%, the fastest in 15 quarters. Operating income of $23.9 billion at a 13.1% margin, the highest Amazon has ever recorded. Earnings per share of $2.78 against a consensus of $1.64. And $44.2 billion in capital expenditure, which is what made the stock nervous. The market is telling a story about a company spending recklessly on AI infrastructure while free cash flow evaporates. The real story is about a company that positioned itself quietly over 30 years to be the arms dealer in the biggest technology capital cycle in history. I'm J.L. Maurer, and this is Conviction Bets. We believe the stories that move your portfolio are usually quieter than the ones that move the tape. Here's where we're going. I'm going to make the case that Amazon is being priced as a retailer when it is actually three structurally distinct businesses, each of which, priced on its own merits, would justify a higher multiple than the consolidated entity gets today. One of those businesses is a chip company you have probably never heard described as a chip company, with over $225 billion in committed orders. And there is a single line item on Amazon's balance sheet, unmodeled, unpriced, sitting in plain sight, that I think could be worth more all by itself than the entire market cap of most companies in the S&P 500. Let me start with what happened on April 29th, because the market reaction was instructive in exactly the wrong way. Amazon beat on every single line. Revenue of $181.5 billion against a consensus of $177.3. AWS revenue of $37.6 billion against a consensus of $36.6. Advertising revenue of $17.2 billion, up 24%. Against an estimate of 16.9, operating income of $23.9 billion against guidance that topped out at 21.5, earnings per share of $2.78 against a consensus, I'll say it again, of $1.64. The stock fell roughly 2% in after-hours trading. Now, I understand the CapEx anxiety. $44.2 billion in a single quarter is a very large number. It was above the market's estimate. Full-year guidance remains at approximately $200 billion, which means Amazon is going to spend more on capital expenditure in 2026 alone than the entire United States spent on interstate highway construction in the decade after the Highway Act of 1,956 inches current. Dollars. That number is supposed to be alarming. I'm going to argue it's actually the most important reason to be interested. The free cash flow number is real, and it deserves honest treatment. On a trailing 12-month basis, Amazon generated operating cash flow of $148.5 billion. But capital expenditure over that same period, net of proceeds from sales and incentives, came to $147.3 billion. The result: trailing 12-month free cash flow has collapsed to just $1.2 billion, down 95% from $25.9 billion a year ago. With Q1 CapEx running at a $44.2 billion quarterly pace, nearly double the rate of a year ago, free cash flow is pointing toward negative territory in the quarters immediately ahead. That is not a rounding error. It is the single most important risk in this story, and I will come back to it when I make the bear case. The question is not whether the CapEx number is large. It is whether the demand that justifies the number is real. And this is where the print gets interesting. AWS ended Q1 with a contracted revenue backlog of $364 billion, not projected revenue, not optimistic scenario revenue. contracted. And CEO Andy Jassy said explicitly on the earnings call that figure does not include the deal recently announced with Anthropic, which is worth over $100 billion on its own. So the real backlog, with Anthropic included, is north of $460 billion. If you believe that demand is real and $364 billion in signed contracts is about as real as demand gets, then the $44 billion in quarterly capex is not recklessness. It's a reservation fee. So what does this mean for an investor? It means the debate about Amazon's capex is almost entirely the wrong debate. The right question is whether the infrastructure being built can serve the backlog that is already on the books. The answer, based on the contract signed, is yes. Now, let me tell you the frame that I think unlocks this story. In every gold rush worth the name, there were prospectors and there were arms dealers. The prospectors bet on which strikes would pan out. Most of them were wrong. The arms dealers sold picks and shovels to everyone, and it didn't matter to them which prospectors found gold. They got paid regardless. Amazon is the arms dealer in the AI gold rush. Here's what I mean by that. Amazon doesn't need to know whether Claude or GPT or Gemini or some model we haven't heard of yet will be the dominant frontier AI system in 3 years. It doesn't need to win the model war. It needs the companies fighting the model war to keep paying their cloud bill and their chip bill and eventually their shipping bill and their advertising bill. The infrastructure is the bet, and the infrastructure is what Amazon has. Think about how this plays out concretely. Anthropic, in which Amazon has invested a confirmed $13 billion, with options to invest up to $20 billion more committed just after Q1 closed, to spending $100 billion on AWS over the next 10 years. OpenAI, once Microsoft's exclusive cloud partner, that exclusivity expired just 2 days before Amazon's earnings, on April 27th, signed a 7-year, $38 billion agreement to run its workloads on AWS infrastructure and committed a portion of its new compute contracts to Amazon's Trainium chip. Meta, Nvidia, Uber, the US Army, Bloomberg, these are among the new AWS customers announced this single quarter. What's happening here is not a normal enterprise cloud sales cycle. What's happening is that every serious AI player has concluded or is in the process of concluding that the only infrastructure that can actually support the compute requirements of frontier model training and inference is a hyperscaler. Enterprise migration from on-premise infrastructure, which had been happening slowly, fitfully for 15 years, has suddenly accelerated because organizations discovered that building AI native applications requires access to compute that they simply cannot build themselves on any realistic timeline. The result is that AWS's contracted backlog grew by more than $120 billion in a single quarter. Not because of a single big deal. Because of broad demand across hundreds of customers, most of whom are in the early stages of a migration they will not reverse. And I know what you're thinking. Azure grew 40% this quarter, 12 points ahead of AWS. Google Cloud grew 63%. Isn't AWS losing the race? My read is no, and the reason is scale. AWS is growing 28% on a $150 billion annualized base. Google Cloud grew 63% on a $20 billion base. These are not the same problem. Adding 28% to $150 billion is more than twice the absolute revenue increment Google Cloud added at 63% growth. The gap in backlog breadth, enterprise relationships, and custom silicon is wider than the growth rate comparison suggests. Being the largest cloud infrastructure business that also happens to have the most contracted demand is not the same thing as losing a race. So what does this mean for an investor? It means the AI infrastructure arms race has a clear, contracted, documented beneficiary with $460 billion of demand already on the books. And that beneficiary is still priced at the consolidated entity level, as if it were primarily a retailer. This brings me to the valuation argument, which is not a traditional valuation argument. It is a sum of parts argument, and the math is surprising. Amazon consists of 3 distinct businesses, each of which has a natural peer set in public markets. None of those peer sets apply a retail multiple. And yet, the consolidated entity trades at a discount to what you would get if you priced each piece against its most appropriate comparables. The first business is AWS. $37.6 billion in quarterly revenue, growing 28% at a 37.7% operating margin. The operating income from this one segment, $14.2 billion in a single quarter, annualized at roughly $57 billion, is larger than the total annual operating income of most S&P 500 companies. No comparable software or cloud infrastructure business trades below 25 times revenue. AWS has more than 2 years of contracted forward revenue already locked in. The argument for a premium multiple is as strong as it has ever been. The second business is one almost no one is discussing. Amazon's custom silicon division, the Graviton CPU line, and the Trainium AI accelerator crossed a $20 billion annualized external revenue run rate in Q1. If you include internal consumption, the effective run rate is approximately $50 billion. Trainium committed orders exceed $225 billion. Trainium 2 is sold out. Trainium 3, which delivers 30 to 40% better price performance than Trainium 2, began shipping this year and is nearly fully subscribed. By any semiconductor company benchmark, not hyperscaler benchmark, this is already a top 3 data center chip business in the world by scale, and it does not appear separately in any standard Amazon valuation model I have seen. The strategic implication is that every inference workload running on Trainium instead of a third-party GPU unit is a workload where Amazon pays near cost for the compute rather than Nvidia's retail price. Andy Jassy said on the call that at scale, Trainium is expected to save tens of billions of dollars in CapEx annually and deliver several hundred basis points of operating margin advantage for inference. That is a structural cost advantage, and it compounds. The third business is the one everyone thinks they understand and probably doesn't. North American retail revenue of $104.1 billion, growing 12% with an operating margin of 7.9%, up from 6.3% in the same quarter a year ago. Order volume grew 15% year over year, the highest rate since the tail end of COVID lockdowns. Advertising revenue grew 24% to $17.2 billion, and the trailing 12-month advertising number now exceeds $70 billion, which is larger than the entire AWS business was in 2018. Amazon is the second largest food retailer in the United States. It delivered more than 1 billion items on a same-day or overnight basis in 2026. So far, that figure came directly from Jassy's letter in the earnings release. Here is the thing most people miss about the retail business. Every other major technology company has implicitly concluded they do not want to be in this business. Microsoft does not have a fulfillment network. Google does not have grocery delivery infrastructure. Apple does not have 1.5 million warehouse employees and a fleet of over 1 million robots. The physical footprint that those companies avoided is precisely the kind of hard asset that technology multiples penalize. It is also quietly becoming the margin expansion engine of the next decade. So what does this mean as an investor? It means you are buying 3 separate businesses, a world-class cloud and AI infrastructure franchise, an emerging chip business with over $225 billion in committed demand, and a consumer logistics and advertising platform, all at a single blended multiple that reflects none of them at fair value. The conglomerate discount is real, and it has never been harder to justify. Now, here's the part of the Amazon story that I think is genuinely underappreciated, not by analysts who cover it in footnotes, but by investors who mostly ignore it. Amazon has over 1 million robots operating in its fulfillment centers. That figure comes directly from the Q1 2026 earnings release, the 8K filed with the SEC. 1 million. Up from roughly 1,000 when Amazon first acquired the Kiva robotics business in 2013. And it has an AI model called Deep Fleet that coordinates the movement of all of them in real time, reducing fleet travel time by 10%. These are not hypothetical robots. They are operating today at scale, handling, stowing, picking, sorting, and transport across more than 300 fulfillment centers worldwide. The business case is straightforward. Amazon's next generation fulfillment centers, the ones designed around robotics from the ground up, reduce processing times by up to 25% and target the same reduction in peak season costs. You can see this in the numbers already. In Q1, order volume grew 15% year over year, while out the door transportation costs grew only 12% and fulfillment costs grew only 9%. That is what operating leverage from automation looks like in a real income statement. And North America operating margin of 7.9%, up 160 basis points in a year, is the financial manifestation of that leverage. The trajectory matters. Amazon's internal documents, as reported by the New York Times and the Wall Street Journal, describe a goal of automating 75% of fulfillment operations and avoiding the need to hire roughly 600,000 people over the next several years as a result. The company is opening new U.S. fulfillment centers in 2026, including facilities exceeding 3 million square feet that deploy robotics and AI into every key production area. These are not experiments. These are the future standard configuration. Now, Zoox, Amazon acquired Zoox, the autonomous vehicle company, in 2020 for approximately $1.2 billion. As of late March 2026, Zoox had accumulated nearly 2 million autonomous miles and carried over 350,000 riders in Las Vegas, San Francisco, Miami, and Austin. It just signed a multi-year partnership with Uber, the first time Zoox has agreed to offer its rides through a third-party app to deploy its purpose-built robotaxis on the Uber network in Las Vegas this summer and Los Angeles next year. For context, Waymo, the acknowledged leader in the commercial robotaxi segment, reported 400,000 weekly rides across 6 U.S. metro areas in February. Zoox is behind Waymo. But the Uber distribution partnership matters because it gives Zoox access to 202 million monthly active consumers without needing to build its own demand network from scratch. And then there is Amazon Leo, the company's low Earth orbit satellite internet constellation. The name comes directly from the Q1 2026 earnings release, where Andy Jassy called it out by name in his letter to shareholders. 270 satellites in orbit as of the call. Commercial service targeted for Q3 2026. A total planned constellation of roughly 7,700 satellites. The CFO said to expect a year-over-year cost increase of approximately $1 billion related to Amazon Leo in Q2 alone, covering satellite manufacturing and launch costs. Already signed commercial commitments from Delta Airlines, JetBlue, AT&T, Vodafone, and NASA before commercial service has even launched. And an agreement to acquire Globalstar, valued at roughly $11.6 billion, to gain the direct-to-device spectrum capacity needed to serve mobile phones and wearables, including an agreement with Apple to provide satellite connectivity to iPhones and Apple Watches. None of this, zero of it, is in the current Amazon multiple. These are 3 separate optionality layers sitting inside a business already valued primarily as a retailer. And let me return to the arms dealer metaphor for a moment, because this is where it gets most interesting. The physical infrastructure Amazon has built, the million robots, the fulfillment network, the last mile logistics, the grocery distribution, is the kind of hard asset that no technology company built after Amazon would ever choose to build from scratch. The capital required is too large. The timeline is too long. The operating complexity is too high. Those are exactly the characteristics that produce a durable competitive moat. And those are exactly the characteristics that Amazon spent 30 years building, while the rest of the technology industry spent 30 years deciding it wasn't their problem. The physical infrastructure no other technology company wanted to build is now the thing no other technology company can replicate. That is a different kind of moat than a network effect or a switching cost. It is a moat made of concrete and robots and rocket launches. And it is only beginning to compound. So what does this mean for an investor? It means the automation of Amazon's physical operations is not a cost story. It is a margin expansion story, one that will play out over years, not quarters, and that is not yet legible in the aggregate numbers. The investors who see it now are reading a different set of financial statements than the ones who are still debating whether the CapEx is justified. Let me bring this back to the investment question, and let me do it honestly, because the bear case here is not trivial. And I know what the bear case is. Amazon is spending $44 billion a quarter on infrastructure that takes 18 to 36 months to generate revenue. On a trailing 12-month basis, net capital expenditure of $147.3 billion has nearly consumed operating cash flow of $148.5 billion, leaving just $1.2 billion of free cash flow, down 95% in a single year. With Q1 CapEx running at a pace that annualizes to over $175 billion, free cash flow is pointed directly at negative territory in the quarters ahead. Long-term debt has grown from $65.6 billion to $119 billion as the company has tapped the bond market to supplement its operating cash flows. AWS operating margin declined 180 basis points year over year. And the AI application layer has not yet proven that enterprise willingness to sign large contracts translates into the sustained growing utilization at the unit economics management is modeling. That is a legitimate concern. Every one of those numbers is real. Here is why the bull thesis survives it anyway. The backlog is the answer to the CapEx concern. $364 billion in contracted revenue, not including Anthropic's $100 billion. That is more than 2 years of current AWS revenue already locked in. The demand is not theoretical. It is signed. And the same dynamics that produce the AI infrastructure build-out, enterprise migration, AI inference demand, the requirement for hyperscaler-grade compute are structural, not cyclical. They do not reverse if a model benchmark changes. On the margin compression, Trainium is the answer. Every quarter that Trainium displaces third-party GPU spend in AWS's own infrastructure is a quarter where the cost side of the AWS margin equation improves. Trainium 2 is sold out. Trainium 3 is nearly fully subscribed before broad availability. Jassy said on the call that Trainium is expected to save tens of billions annually at scale and deliver hundreds of basis points of inference margin advantage. The margin compression from the CapEx cycle is real, but it has a floor, and that floor is when Trainium's cost displacement becomes the dominant variable. Now, let me also be specific about the Anthropic investment, because I think it is the most underappreciated element of this story. Amazon has committed $13 billion to Anthropic, with options to invest up to $20 billion more. In return, Anthropic has committed to spending $100 billion on AWS over 10 years. That is the contractual relationship. But the equity relationship is separate, and the equity trajectory is extraordinary. Bloomberg confirmed in March of this year that Anthropic had surpassed $19 billion in annualized revenue, up from $9 billion at year-end 2025. That is more than a doubling in roughly 3 months. Anthropic is reportedly targeting an IPO as early as late 2026. Secondary market pricing has put valuations north of $800 billion. Amazon's equity stake, estimated in the mid-teens percentage-wise, could be worth somewhere in the range of $100 to $120 billion at those figures. That is not in any consensus model. It is not in the current multiple. And it does not require Anthropic to be the dominant frontier model company to be a very large number. Here is where I land. Pause. The bet on Amazon is not a bet on whether it wins the AI model war. The model war is mostly irrelevant to the investment thesis. The bet is that the arms dealer gets paid regardless of which prospectors strike gold, that the infrastructure rents compound as more workloads migrate to the cloud, that the robot in the fulfillment center is a better margin story than any analyst has fully modeled, that the Trainium chip turns a cost center into a competitive advantage over 3 to 5 years, and that the Anthropic stake sitting on the balance sheet, unmodeled, unpriced, could be worth more than the market cap of most S&P 500 companies by the time it becomes liquid. The company that built the dominant cloud infrastructure in the 2010s is now building the dominant AI infrastructure in the 2020s. It is doing so while simultaneously automating the cost structure of the largest consumer logistics operation on Earth. And it is doing all of this from a cash flow and scale position that no competitor can match. Amazon doesn't need to win. It needs everyone else to keep playing. Anyway, that's this week. If you prefer to read, the show has a Substack called Quiet Velocity. Find it at quietvelocity1.substack.com. That's Quiet Velocity, the number 1.substack.com. And if you're enjoying Conviction Bet, subscribe wherever you get your podcasts, Apple, Spotify, YouTube, Amazon, whatever you use. Leave a review if you have 30 seconds. It genuinely helps new listeners find the show. Until next time, stay patient, stay skeptical, and keep your eye on the quiet stuff. I'm JL Maurer. This has been Conviction Bet.